$7.6 trillion evaporated from Japan's bond market in a single trading session on January 20th, 2026. That number is so large it's almost meaningless until you realize what it actually represents. This wasn't a stock market hiccup. This wasn't crypto volatility. This was the systematic destruction of value in what's supposed to be the safest, most boring investment on earth. Government bonds. And the shockwave didn't stop at Japan's borders. Within hours, US Treasury yields spiked, European markets convulsed, gold crashed, silver plunged double digits in under 60 minutes. Bitcoin got obliterated alongside everything else. Traders are calling it the everything fall, and they're not exaggerating. When the assets you run to for safety during a crisis are themselves collapsing, you're not in a normal market correction anymore. You're watching the architecture of the global financial system crack in real time. What happened in Tokyo on that Monday morning has been described by market participants as the most chaotic trading session in recent memory. The 30-year Japanese government bond yield jumped a full quarter point in a single day. Let me put that in perspective for you. That's a move that normally takes weeks or months. It happened in hours. The 40-year bond yield crossed 4% for the first time since that security was even created back in 2007. Bond traders will tell you this is statistically impossible, a Six Sigma event that shouldn't occur in our lifetimes. But it did occur, and it's still unfolding. You're probably wondering why you should care about bond yields in Japan when you're trying to figure out whether your retirement account is about to get cut in half. Fair question. The answer is going to make your blood run cold. Japan holds $1.2 trillion in US Treasury bonds. They are the single largest foreign owner of American government debt, more than China, more than every European nation combined. And for 3 decades, Japanese investors have been pouring money into US assets because of something called the carry trade. Here's how that worked, and why it just broke. You borrow yen in Japan at basically 0% interest. Convert those yen to dollars. Buy US treasuries paying 4 to 5%. Collect the spread as pure profit with almost no risk. It was the greatest free money trade in the history of finance, and it funded everything. Hedge funds leveraged it 10 times, 20 times, turning 5% returns into 50% or 100% annual gains. This wasn't some niche strategy. Estimates suggest the total notional exposure in leverage carry trades could be $15 to $20 trillion. That trade just died. Japanese government bonds now yield between 2% and 4% depending on maturity. Why would any rational investor take currency risk, send money to America, and buy treasuries at 4.8% when they can stay home and buy Japanese bonds at 3.7% with zero currency exposure? They wouldn't, and they're not. The unwinding has already started. You saw the preview in August 2024, when the Bank of Japan surprised markets with a small rate hike. Bitcoin crashed 23% in 3 days. The Nasdaq dropped 10%. $2 trillion in market value vanished in 72 hours. That was a tremor. What's happening now is the earthquake. The trigger was almost comically predictable in hindsight. On January 20th, Japan's Prime Minister Sanae Takaichi announced a snap election and simultaneously unveiled her economic platform. She promised to break free from excessive fiscal austerity. She pledged to suspend the 8% consumption tax on food for 2 years. She proposed a record budget of over 122 trillion yen. And when asked how she'd pay for tax cuts that would cost 5 trillion yen annually, she had no answer. The implication was obvious to everyone watching. More debt. A lot more debt. Japan's debt to GDP ratio already sits at 236.7%. That's not a typo. Japan owes more than twice its entire annual economic output. It's the highest ratio among developed economies by a massive margin. And their new prime minister just announced she wants to borrow even more while cutting taxes. Bond investors looked at that math and ran for the exits. Traders immediately compared it to the Liz Truss moment in the UK back in September 2022. Truss proposed unfunded tax cuts, the bond market revolted, the Bank of England had to intervene, and Truss was forced to resign after 49 days. Japan's situation is worse because the debt levels are exponentially higher and there's no easy bailout mechanism. The Bank of Japan already abandoned yield curve control, the policy where they artificially suppressed rates by buying unlimited bonds. They're not the buyer of last resort anymore. When the sell-off hit, it was violent and indiscriminate. Yields that had been stable for years moved further in one session than they had in the previous 12 months combined. Market participants described conditions as chaotic, which in bond trader language means complete panic. This is the market that's supposed to be boring. This is where pension funds and insurance companies park money for safety and predictability. And it just experienced a meltdown that defied every statistical model. Ken Griffin, the billionaire founder of Citadel, one of the most sophisticated hedge funds on earth, called the Japanese bond sell-off an explicit warning to the United States. He pointed out that America now has $38 trillion in debt, with an annual interest bill exceeding $1 trillion. His message was clear: the bond vigilantes can come out and exact their price. What happened in Japan is a very important message to the House and the Senate. That warning isn't theoretical anymore. US Treasury yields immediately spiked following the Japanese chaos. The 10-year Treasury yield surged nearly 6 basis points, climbing toward levels not seen since August. The 30-year Treasury approached 4.918%, dangerously close to pre-2008 financial crisis highs. And this is where the contagion truly begins, because the problems in Japan don't stay in Japan. Japanese institutions hold $1.2 trillion in US Treasury bonds. That's more than China, more than any European country, more than any other foreign holder of American government debt. And they're about to start selling, not because they want to, because the math forces them to. For 3 decades, Japanese investors have been buying US debt in absolutely massive quantities. It was the greatest trade in the history of finance. You borrow yen in Japan at 0% interest. Convert those yen to dollars. Buy US Treasury bonds paying 4 to 5%. Collect the spread. This is called the carry trade, and it's been printing money for institutional investors since the 1990s. But Japanese government bonds aren't yielding 0 anymore. They're yielding 2 to nearly 4%, depending on maturity. So ask yourself this: if you're a Japanese pension fund or insurance company, why would you take your yen, convert them to dollars, which creates currency risk, send that money to America, and buy US Treasuries yielding 4.8%, when you can just buy Japanese government bonds at home yielding 3.7% with 0 currency risk? You wouldn't. No rational investor would take that trade anymore. The risk-adjusted return just evaporated. That means hundreds of billions, potentially over $1 trillion in US Treasuries, are going to be sold as these positions unwind over the next 12 to 24 months. That's enormous forced selling pressure on US government debt. And it gets exponentially worse because it's not just Japanese institutions doing the carry trade. Hedge funds saw this free money and said, let's leverage it. If you can make 4 to 5% risk-free, what happens when you leverage it 10 times? You make 40 to 50% annually. What if you leverage it 20 times? You make 80 to 100% returns. Nobody knows the exact number because hedge funds don't publicly report their positions. But estimates from major banks suggest the total leveraged carry trade could be $15 to $20 trillion in notional exposure. $15 to $20 trillion in leverage bets that are now underwater and mathematically have to be unwound. Here's what that liquidation looks like in practice. When hedge funds get margin calls because their carry trades are losing money, they don't just sell Japanese bonds. They sell everything. They dump US stocks. They dump crypto. They dump commodities. They sell anything liquid to raise cash immediately and cover losses. This is indiscriminate forced liquidation driven purely by survival. Your tech stocks get sold not because Apple or Microsoft are failing. They get sold because a hedge fund in London needs to raise $3 billion by market close to meet margin requirements on blown-up yen positions. Your retirement account takes the hit because someone else's leverage just exploded. And almost nobody is prepared for this. According to Bank of America, half of all major institutional money managers currently have zero downside hedges in their portfolios. Zero protection. They're fully long, fully exposed, completely unprepared for a major sell-off. Everyone is on the same side of the boat. When everyone tries to exit simultaneously, the boat flips. But it gets substantially worse. Because it's not just Japan creating selling pressure on US bonds. Europe holds approximately $3 trillion in US Treasury bonds. That's triple what Japan holds. And European governments are broke. They're facing massive pressure to increase defense spending because of Ukraine and political pressure from Washington to spend 3 to 4% of GDP on military. Where are they getting that money? They're going to sell assets. And one of the biggest, most liquid assets European governments and institutions hold is US Treasury bonds. So you've got Japan potentially selling over $1 trillion, Europe potentially selling portions of $3 trillion, and the US Treasury Secretary's response, hope. Scott Bessent was asked about this crisis at Davos. His answer was that he's been in touch with his counterpart in Japan, and he's sure they will begin saying things that will calm markets down. Saying things. Not implementing solutions, not fixing structural problems, just talking, reassuring words to make bond markets feel better. When the Treasury Secretary of the United States is reduced to hoping that Japan will say nice things to calm investors, you know there's no actual plan. The adults are panicking and they're completely out of tools. Now let me explain something that most people, including many financial advisors, don't fully grasp. It's called correlation breakdown. In normal markets, when stocks go down, bonds go up. That's the entire foundation of portfolio diversification. You have a 60-40 portfolio, 60% stocks, 40% bonds. When stocks crash, investors flee to safety. They buy bonds. Bond prices rise. Your bond holdings offset your stock losses. The portfolio is hedged. But when the government's creditworthiness itself is in question, stocks go down and bonds go down together. The hedge breaks. The correlation flips. And you get destroyed on both sides simultaneously. Your stocks fall because of forced liquidation from unwinding carry trades. Your bonds fall because rates are spiking and nobody wants to buy government debt at current yields. This is what happened in the UK in 2022 when Liz Truss nearly collapsed the gilt market. Stocks and bonds both crashed at the same time. British pension funds almost went bankrupt. Ken Griffin just issued a direct warning about exactly this scenario. He said bonds lose what makes them special in a portfolio when bonds and stocks move together in prices. Translation? Your hedge is gone. Your 60-40 portfolio is now 100% risk. Both sides are moving down together. You're not diversified, you're just exposed everywhere. So what do you actually do when the traditional hedges don't work? Let me give you the strategy that actually makes sense based on what's unfolding right now. First, understand your current exposure. Go look at your portfolio this second. How much is in stocks? How much is in bonds? How much is in cash or other assets? If you're heavily weighted towards stocks and bonds with minimal hard asset exposure, you're in serious danger. Second, watch the specific levels that signal this crisis is accelerating. US 10-year Treasury yield above 4.75%. That's a warning sign that foreign selling is overwhelming demand. US 30-year Treasury yield above 5%. That's a crisis signal that long-term rates are spiraling out of control. Dollar-yen exchange rate below 140. If the yen strengthens rapidly, It means carry trades are unwinding fast, and Japanese investors are selling dollars to bring money home. Third, defensive positioning. This isn't about getting rich quick. This is about not getting poor. Certain sectors and assets historically hold up or even benefit during these crises. Energy stocks like ExxonMobil and Chevron. Energy is essential. Demand doesn't disappear during recessions. These companies pay dividends and have pricing power. Materials, specifically gold and silver through ETFs like GLD and SLV. Gold is hitting all-time highs right now for a reason. When government debt is in crisis and currencies are unstable, gold holds value. Quality technology. Microsoft, Apple, Google, Meta. These companies have fortress balance sheets, generate massive cash flow, and aren't disappearing. They'll survive and likely raise prices through any downturn. Consumer staples. Coca-Cola, Procter & Gamble, Walmart. People still need to eat, clean, and buy basics even in a deep recession. What should you avoid? Regional banks and financials. They're sitting on massive unrealized losses on bond portfolios. If rates spike further, more banks will fail. High debt companies. Any company with weak balance sheets and lots of debt refinancing coming due at higher rates will go bankrupt. Consumer discretionary and luxury goods. When people are worried about money, they stop buying $2,000 handbags. Speculative tech. Unprofitable companies burning cash with no path to profitability get slaughtered when rates rise and risk appetite vanishes. Fourth, hard asset allocation. This is controversial, but I believe it's essential. Move a portion of your portfolio, 10 to 20%, into hard assets that aren't someone else's liability. Physical gold, physical silver, potentially Bitcoin, if you understand the risks and extreme volatility. These are assets that aren't tied to government solvency. If the bond market breaks and currencies weaken, these hold value or appreciate. I'm not saying dump everything into gold. I'm saying allocate enough that if the bond market cracks and the dollar weakens, you have a hedge that actually functions. Fifth, avoid the cash trap. A lot of smart investors are saying move to cash and wait this out. I disagree completely. Cash is going to get destroyed by inflation. If the Fed has to restart quantitative easing to bail out the system when this crisis peaks, they'll print trillions. The dollar will weaken. Inflation will spike. Cash loses purchasing power rapidly. Cash is useful for short-term liquidity, but it's absolutely not a long-term safe haven in this environment. The bottom line is this. Japan's carry trade unwind is not theoretical anymore, it's happening. Japanese bond yields are at 30-year highs. The Fed is intervening in currency markets to prop up the yen. US Treasury yields are spiking. We're in the early stages of what could become a $15 to $20 trillion forced liquidation event. Your portfolio is exposed whether you realize it or not. The traditional 60-40 portfolio won't protect you. The hedge is broken. Stocks and bonds will move down together. The next 90 to 180 days are going to determine whether you're positioned correctly or whether you watch your wealth get cut in half. This isn't about fear-mongering. This is about mathematics. The carry trade math doesn't work anymore at current rates. Japanese investors will sell US bonds. Hedge funds will be forced to unwind leveraged positions. Markets will fall. The only question is whether you see it coming and position accordingly, or whether you ignore it and hope it somehow goes away on its own. Hope is not a strategy. Math always wins. And the math says this crisis is accelerating. The trigger was Japan's bond market chaos on January 20th. The mechanism is 15 to 20 trillion in leveraged carry trades unwinding. The result will be forced liquidation across stocks, bonds, real estate, and crypto. The timeline is the next 3 to 6 months as these positions get closed out, and the victims will be anyone who stayed fully invested in traditional portfolios, thinking diversification would protect them. If this analysis helped you understand what's actually happening and why it matters to your money, subscribe right now and turn on notifications. The next video is going to cover the specific timeline for how this unfolds and the exact trigger points that tell you when to increase defensive positioning even further. You need to see it before the next wave hits. Stay informed, stay prepared, and don't let this crisis catch you completely blind. The Japanese bond market just fired a warning shot that echoed across every financial market on Earth. What started as a chaotic trading session in Tokyo has exposed vulnerabilities in the global financial system that have been building for 30 years. The carry trade that funded trillions in investments just broke. The math that made it work no longer exists. And the unwinding of $15 to $20 trillion in leveraged positions has already begun. This isn't speculation about what might happen. The forced liquidation is happening right now. Japanese yields have spiked to levels not seen in 3 decades. US Treasury yields are climbing toward crisis levels. Traditional portfolio hedges are failing because stocks and bonds are falling together. And the Treasury Secretary's only response is hoping that reassuring words will calm the markets. You have a choice to make in the next few weeks. You can acknowledge that the financial architecture underpinning global markets just cracked and position your portfolio defensively. Or you can hope this somehow resolves itself without touching your retirement account. One of those strategies is based on mathematical reality. The other is wishful thinking. The difference between them will determine whether you preserve your wealth or watch it evaporate alongside everyone else who thought this time would be different.